Hello traders, and welcome to the first video within the second section of the IPDATrader's private mentorship. And this entire section, guys, is going to be dedicated to points of interest. You're going to learn everything you need to know about points of interest, why they form, what they mean, what we actually look for, and how we can really take advantage of those points of interest and really help our trading, right? Because as we discussed before, structure alone is not enough. And especially once you start understanding points of interest and potentially partnering those ideas with structured plays that you may be expecting from a particular market, you will see how everything slowly starts to make sense to you. So without further ado, let's go to the drawing board and let's start discussing points of interest. We're going to be starting sort of very basic, and we're going to be getting more in depth as you go through the videos. So as we said, points of interest is what we're going to be discussing today. Now, the question you may have at this point could be something like, what is a point of interest, right? And if we're looking at a point of interest from our retail perspective, right? Don't forget, even though we trade smart money concepts and really algorithmic ideas, we are at the end of the day still retail traders, and we need to understand that. Well, from our retail perspective, a point of interest is a specific price area. Usually we denote them with a rectangle that we want to watch for potential executions, right? It doesn't mean that you're always going to be executing at your points of interest. It just means that it is an area that you want to watch, and you can potentially execute trade ideas from there, right? So now that you understand what a point of interest is in regards to our retail perspective, let's actually get started on why they happen, what they mean, and what is actually going on behind the scenes and why they form. So guys, let's actually get started. Let me remove this stuff and let's draw a potential bearish market for this example, right? And we're going to be diving deep into this. So what is actually happening here, right? And one thing you need to understand is that that smart money, central banks, the algorithm does not trade anywhere close the way we do, right? They are not looking at specific price points where they want to take positions. No. Smart money and institutions are constantly buying and selling the market, right? Whoops. They're buying over here a lot, right? They're taking a lot of buy positions, sell positions, constantly selling, buying again, then selling. Now, at some points, they're selling more than they are buying, and that is why a particular market can be heading in a particular direction. Just like in this case, we have a market that is pushing down. Well, that means that smart money is selling more than they're buying, hence market is pushing down. But still, at the end of the day, they're buying over here a lot and they're selling over here a lot. And if we partner this idea with the idea of points of interest, you will start slowly seeing how this makes sense. So really, a point of interest is a move through liquidity in the opposite direction that leads into a break in market structure, right? Let's imagine the market was coming down like this and you break structure over here. And this is really what a point of interest means, right? It's the move through liquidity into the opposite direction. This is liquidity. This is a move through liquidity, and this is the given direction that they decided to head. So if we take a look at this particular leg down over here, right? Just this leg down, we're going to be focusing on this because this is going to grant you a good understanding of points of interest just to start with. So what is essentially happening here is that smart money is pushing price down over here. They're taking sell positions, potentially pumping in billions of dollars into sales to then just buy it all out, right? And now you may be asking yourself, well, that sounds stupid, right? If they want to push up, why would they actually put so much money into selling? And this is where the idea of smart money actually comes into play. Now, what you need to understand at this point, right, and what I want you to understand is the following. The reason why smart money may be selling at this point varies, right? One of the reasons what they may be looking to sell the market over here is because we may have some sort of liquidity sitting across here, right? You can imagine this is a trend line. And what do we know about trend line? Well, retail traders are going to be looking to buy over here, and the stop losses are just going to be below that area. So that means that smart money is actually selling over here to take that liquidity out. That is then going to relieve them from potential negative positions into buy positions over here. They are doing so because they want a better buy price over here. Once they buy, they're literally buying at the bottom, so they have the better buy price and they're taking sell stops out, right? We understand that below and above every single swing, we have liquidity, right? We have sell and buy stops resting over there. So the moment, right? And let me get rid of this stuff because we're going to need the space. Get rid of this. So the moment we start selling over here, right? We start selling over here and then we start buying up. The moment we get above structure, that means that this entire region over here from top to bottom is considered your point of interest. Reason being is because they sold very hard at this point to then buy up, meaning that there's going to be plenty of sell positions over here that are going to be in the negative, right? As I said before, moving price down in such a manner costs a lot of money, and they're going to need to return here at some point, right? At some point, they need to get back down here because, yes, as they're pushing price up, they're making tons of money with the buys that they took over here. Remember, they sold to buy, so the buys are making tons of money, but the sells that are still open are in the negative over here at the top. So they want to return into that particular point of interest to then relieve them from the sell positions, right? Close them out at break even, and they can keep making money with the buys up. So traders, before we get into the actual lesson of today, just a very quick word from our sponsor today, IPDATrader. IPDATrader is a regulated broker which has been in the industry for over 14 years, which gives you a lot of confidence when it comes to executing trades, depositing money, withdrawing funds, trading funds, as they're a very well known and very respected and established broker in the industry. They allow you to trade pretty much anything you want, including forex, indices, commodities, stocks, cryptocurrencies, and they have something that not many brokers have, which is a zero commissions account for forex pairs on ECN plus accounts. So if you're interested with them, guys, you will find the link in the description below. Use the link in my description to sign up with them, as if you do, you will be eligible for a 100% matching deposit using it, which is very, very good and not many other brokers will do. So once again, massive thank you to IPDATrader for sponsoring this video, and now into today's lesson. Enjoy the video. So if we translate this into candles, it could look something like this, right? And I'm pretty sure you've seen this scenario multiple times, right? Let me get rid of some of this stuff and let me actually redraw it. So as we said before, we had the structure point over here, we had the down move, and we had the aggressive up move. So this could look potentially something like this, right? You may see a huge bearish candle like this, right? This is a bearish candle, and all of a sudden you get a big bullish candle that just pushes up like this, and you may try to sell below here and you are left wondering, well, what is happening, right? So what is essentially happening is that smart money is selling very hard to then buy very hard. So that means that at some point in time, they're going to need to return into this point of interest, guys, and this is where points of interest come into play. And again, they look very differently depending on which one you're looking for, but we're going to be starting out with this example over here. So we understand that the last down move before the up move that breaks structure, right? We can see we break multiple layers of structure over here, is your point of interest. Reason being is because now you understand that smart money institutions sold very hard at this point to then buy it all back up. So we understand that negative sell positions are laying over here, and they want to get rid of those. So we understand that they want to return. This would then be our retracement, right? If we partnered this idea with structure, and then we're going to continue pushing higher. To sum it all up, guys, any down move before an up move that leads into a break in market structure is considered a point of interest, right? So if we remove this stuff over here, just like this, we understand that this is a down move before an up move that leads into this break in market structure. So this is a valid point of interest. However, guys, there's ways you can actually refine those points of interest, right? You can, if you start zooming into even lower time frames, right? Let's imagine this is your 1 hour time frame. If you go into a 15-minute, you can potentially find that that same down move before the up move can now potentially look something like this. Let's get this tool. You can have even a bearish candle within that 1 hour bearish candle, even lower over here, and your up move actually starts over here. And this is a valid point of interest, right? And then the rest of the candles keep pushing up because, as we can see, price ends up closing over there. So we understand that this on its own is also a point of interest right here. From this bearish candle wick high to the bearish candle wick low is a point of interest inside a point of interest. So this is what the idea of the fractal nature of the market actually starts coming into play, and why I really emphasize on the previous section, on the previous structure section, about that idea, because that's really going to be something you're going to be seeing across the different sections. So now that we understand the theory, right, in regards to a point of interest, and this is again just looking at a particular example, you're going to learn all the different points of interest as you go through the videos. But for now, this is a particular example of a bullish point of interest. If we were to be looking at a bearish point of interest, it would just be really the same thing, right? Let me grab red, just flip the other way around. And let me actually start from the bottom over here. We understand now that the moment we trade below this low, right here, this becomes our point of interest, this entire section. And as we said before, this is going to look something like this. You're going to have a huge up move right here that leads into a huge bearish move that breaks structure right over here, just like that. And this entire section over here is your point of interest. However, as we discussed, you can zoom into lower time frames, and you can potentially see that on a lower time frame you can have a more refined up move over here into a more refined bearish move over here. And that is also a valid point of interest, right? You just need to understand that the more you refine those points of interest, the lower the probability you're going to have that those points of interest are actually going to get mitigated, meaning that they're going to return over there and continue lower, which should be your expectation, right? So the more you refine, the lower the probability you're going to have of those actual refinements getting hit. As I said, guys, do not get it twisted. There's multiple ways points of interest can look, but we're just focusing on this scenario, right? And we're going to go back to the charts, and we're going to be taking a look into that, right? So let's get rid of the stuff. And as we said before, guys, any move against liquidity or through liquidity that leads into an up move is considered a point of interest. This entire region right here is your point of interest. However, as we discussed, you can refine that into even more refinements, right? You can really, as you go through the time frames, for example, if we take this last down move before the up move, we can clearly see it over here, right? We see that this is a down move over here that, if we look left, took all these sell stops resting below these lows, right? Got taken out with this last down candle before the up move that broke structure over here. If we zoom into lower time frames, we can potentially see, oh my god, I hope I can go that far back. Yes, you can see that that same down move before the up move can be refined now to this candle. And if we go through lower time frames, you could potentially see it refined to this candle. And as we said before, the lower the time frame you go, the lower the probability you're going to have of that actual point of interest getting hit. Just like in this case, we never mitigated that far, and that's fine. So let's actually go back to the 4 hour as we were looking at. And over here, And let's actually use the 4-hour point of interest. So we understand that the moment we trade above that high, this becomes a point of interest, right? And this on its own, it's a point of interest as well, right? Because if you look at it logically, this is also a down move that led into a up move. And if we go higher time frames, we'll probably see that that might be a even higher time frame order block, right? So not in this case, maybe a daily, a weekly, right? I'm not going to spend too much time trying to find this, but this is there we go. As you can see, this point of interest over here is actually a weekly order, weekly point of interest. However, we decided to zoom into the 4-hour, and we can really refine it to the last down move before the up move, which is this block right here, right? And this is what we call an order block. And this is a type of point of interest. And as you go through the videos, you're going to learn that we do not only have order blocks as point of interest. We have breaker blocks, right? We have FU candles. We have liquidity voids. And we also have IFC structures. And those are going to be the points of interest you're going to learn. I'm just teaching you here the concept of point of interest and really order blocks, right? So we refine it back again, and as we can see, right, we break structure. And if you paid attention to my structure videos, you should understand that in the nature that we broke the structure is a wick. That means that price needs to return all the way down, and that's what we actually do, right? We return all the way down, we hit it, right? You can clearly see how we hit the block and we start trading away. So if we were to follow price in regards to this principle, right? And let me get rid of this stuff and we keep this. Now you can say to yourself that this on its own right here, and if we use the replay tool and we just follow price, right? We're monitoring price, we're expecting price to hit the block, which is our point of interest, and we're going to see what happened at this point. Okay, we hit the block and we move up, and now what you need to understand is that this wick right here on its own is a point of interest as well, right? Reason being is because that wick over here, if we zoom into a lower time frame, it's going to look something like this, which is essentially the same thing, a down move before an up move that really breaks structure on a lower time frame. So that's absolutely valid as a point of interest. So let's keep watching. So now we're expecting that price should return here because we know that they took sales that they need to get rid of and move higher. Now we're not going to get into where should it go, how high is it going to move. That's really not the aim here. I'm trying to really convey the idea of points of interest and nothing more. So let's actually play it slower over here. So we see that we trade into it and you get bullish reactions away, right? Reason being is because they had to return here to close those sell positions out to then just move higher, right? So price moves away, right? And at the same time, guys, this is fractionally occurring all the time. This is a down move before an up move that broke structure on a lower time frame, and as you can see, it really didn't work that time, and that's fine, because what you will find is that points of interest, and in particular this type of point of interest, do not need to work on their own, right? You need to partner the ideas of points of interest with more ideas, and you're not going to be expecting every single down move before up move to work, right? So now we start to look at a bearish scenario, right? Just so we can really showcase the other side. Let's see what we have here. Right here. So we can see that we have a up move before a down move, and the moment we trade below that, that is a valid point of interest. So we're going to highlight the entire section over here. And let's see, as you can see, price comes down, trades back into it, and moves lower. It comes back one more time. It comes deeper, meaning there's deeper zones and deeper refinements that are going to get triggered at this point. So if we pay attention, we could have refined it to this last up move, right? You see this little doji candle, that is a up move before a down move as well on its own. So you can take that, and as you can see, price comes back and hits that perfectly, right? We hit that and we move lower. And this is where really smart money concepts start to get powerful, and where you can really find those high RR position. Because if you're waiting for that refinement, that means that your probability of that refinement getting hit is low. But if it does, and if you actually choose the right point of interest, you can have a phenomenal trade, right? So we follow price, right? In the same sense, we understand that this is now a up move before a down move that broke structure over here, potentially on a lower time frame, right? We're not focusing on structure at this point. We're just focusing on points of interest. So we see that this is sort of what we call the last point of true mitigation, but that's for another video. We're going to be focusing on that. So we understand that this on its own is a point of interest. So our expectation should be that we're going to trade into that and potentially move lower. Right now, I don't know if this is going to happen, right? But this is a expectation you could have. You could say to yourself, this is a up move before a down move that broke structure, and we may see lower prices from here. So you could do something like that, right? So let's see. As you can see, guys, we trade into it perfectly and we start moving away over here. Now, this doesn't mean that I'm going to be seeing new lows, but this just showcases the idea that orders are being taken out at this point, hence why you see those huge rejections away from the point of interest. So let's keep watching. Okay, same idea over here, right? You see a up move before a down move. So this is now that break structure over here. So now on the end, we understand that this is a valid point of interest. And this is how you can really be monitoring points of interest back and forth, and let's see what happens, right? Doesn't mean it's going to hold, because we're not taking into consideration the bigger picture, the structure and whatsoever. We're just focusing on the last up move before the down move. So this should be valid on its own. Let's see what happens. And it gets taken out. And that's absolutely fine, because you need to understand that this type of point of interest, which is essentially a order block, what you're learning here, they don't need to hold on their own, right? You need to partner them with other ideas that you're going to be learning throughout the different sections. So essentially, guys, do not get confused just yet. This is just the first video of the points of interest section, and it's going to start making more sense as you go through the videos. So one last thing I will tell you within this video is that another reason why we really like points of interest and we really use them is because they can prevent you from taking emotional and dumb decisions, right? Because if you have a market like this, let's say you have a move up over here and you identify this as your point of interest, well, you don't need to do anything else in this market and potentially get FOMO over here and try to take buys over there, right? But then it fails. You just can simply wait for your point of interest over here. Maybe you refine it even lower and you said to yourself, okay, I don't want to be doing anything in this market apart from waiting for my point of interest to get hit. And at that point is where I want to be active and really try to catch my positions and take my trades. So it really prevents you from taking dumb trades all across different whatever you may have been using all the time. Maybe you try to buy over here because you see, for example, accumulation or whatever, right? You just can now simply say to yourself, okay, I want to be buying at this price because this is my point of interest. This is a refinement that I like, and this is going to give me a good RR if the actual mitigation play that is going to occur here works and moves higher. At the same time, if you were expecting sales over here, right, you can have a point of interest for buys. You can have another point of interest for sales over here. As we can see, this is a valid up move before down move that breaks some sort of structure over here and that took liquidity up here. You can say to yourself, okay, in this market, I don't want to be involved unless we're hitting over here or unless price is over here. And really that way you're going to avoid taking dumb trades, maybe in the middle of the range where you don't really know what's happening and that sort of stuff, right? So what you've essentially learned in this video is a particular type of point of interest, which is the order block, more particularly a origin if you're looking at the really last up move before the down move, or the last down move before the up move. You're looking at the origin order block, and that's just one of the types. You're going to be learning about all the different ones as you go through the sections, right? Because as you can see, you see too many up moves before down moves, and down moves before up moves happening all across the charts, right? And it can get really confusing, and for that reason is why we don't just use points of interest alone, and we partnered that idea with structure, confirmations, liquidity, time, and all that sort of stuff. So main takeaways from this video, guys, it's pretty self-explanatory. You should understand that a down move before an up move is smart money actually selling very hard to take people out, to have the better buy price, to then push price higher, and that they really need to return here at some point in time to close those sell positions that they took over here out, so that they can continue pushing price higher if that's what they really want to do at that point. So take your time with this video, digest the information, and I will see you guys very soon.